Welcome to a special end of financial year edition of Taking Stock. I'm Tim Lincoln, and joining me today is Kien, Trinh, our head of Stock Doctor Research, and we're both here to stream you all things share market. Well, it's certainly been a very challenging year for equity investors, with the Australian market down some 7.4% for the 12 months, while the US market fell 11.9%. So a lot more volatile in the US. Meanwhile, the S&P ASX Small Ordinaries Index has dropped some 19.5%, while the large caps or top 50 Australian stocks have only declined by 4.4%. So it's really been that smaller growth end of town that has suffered the most in this very, very volatile environment. But no doubt the year was of two halves, with most of the volatility appearing in the second half of the year, especially in the last 2.5 months. Ongoing COVID restrictions led by supply chain constraints, with material and labour shortages really contributing the most. Meanwhile, consumer demand for goods and services continued to rise as the world emerged from lockdowns. The supply and demand imbalance led to elevated inflationary pressures, and this was compounded further by the Russian-Ukraine conflict, which drove oil prices to trade above $100. As a result, the annual Australian inflation rate jumped to 5.1% and surpassed the market estimates of around 4.5%. In turn, the RBA was forced to clamp down on skyrocketing inflation by aggressively raising interest rates and abandoning its monthly bond purchases that were being used to stimulate the economy, Kien.
Yeah, that's right, Tim. I mean, rising interest rates have led to a sharp rotation from growth and quality investing towards the larger cap defensive value stocks, especially across those resources. And growth stocks, they are more sensitive to rising interest rates because they tend to have larger cash flows into the future. So higher interest rates reduce the present value of these cash flows. This, coupled with often high PE multiples, has led to the severe underperformance of growth stocks over the past few months. And the chart on screen shows the ratio of growth over value. When the line rises, it means growth is outperforming value and vice versa. As you can see, the larger than expected interest rate rises has led to the underperformance of growth stocks from November 2021. On a positive note though, since May, we have noticed a recovery across the growth universe, possibly as investors look at oversold opportunities within this space, but time will tell whether this can last.
Yeah, thanks, Kien. And due to this severe rotation away from quality and growth stocks, our star growth stocks have underperformed the market considerably over the year, unfortunately, of course. But for us, investing is about the long term. Absolutely, it's about the long term, especially 5 years plus. And as you can see on the chart on screen, over the last 27 financial years, star growth stocks have only underperformed the market in 4 years, translating to a success rate of around 85% and a mean per annum outperformance of around 9.5%. Better still, there has only been 3 years that star growth stocks have generated negative returns. So this is hopefully just a very abnormal period. The underperformance has occurred in the last 2 years, and that had never happened before either. But hopefully this is just one step back in order for the market to take 2 steps forward into the future, especially for those star growth stocks. For income investors, a similar story emerges. With our star income stocks, over the last 10 years, they've only underperformed the market in 2 of those 10 years and delivered a mean outperformance of around 3.8% and an average yield of around 5.9%, which is really strong positive outcomes. This is an incredible statistic, given that the income stocks tend to be more defensive in nature and hence usually underperform in rising markets. Unfortunately, over the last year, star income stocks have been impacted by the rotation away from quality and bond proxies, such as REITs and utilities, from rising interest rates at the moment. Our quality retailers have also been sold down considerably, Kien, as investors shy away from consumer-related stocks.
Yeah, and with interest rates expected to rise further, many investors may be wondering whether growth and quality investing will continue to underperform the market. The chart on screen here compares the Australian growth versus value ratio in blue with interest rates in grey and bond yields in orange from 1995. And the key takeaway from this is that although rising interest rates has dampened the performance of growth stocks over the last 6 months, it doesn't automatically translate to the underperformance of growth stocks. In fact, in 2006 to 2009, growth stocks performed well despite a rising rate environment. At the end of the day, the long-term performance of your investments will be driven by the fundamentals and quality of the businesses in your portfolio, irrespective of the market cycle.
Yeah, and since the onset of COVID, Kien, the number of Australian corporate failures has halved from around 700 per month to 350 on average per month. This was due to the low interest rate environment, government support package, and the relaxed insolvency laws. However, leading indicators such as manufacturing activity, like the PMI, are pointing to a slowdown in the market cycle. Rising interest rates, no stimulus, and weaker economic activity tends to correspond to higher corporate defaults as debt-laden companies are faced with rising debt costs and diminishing cash flows.
Yes, Tim, and in fact, according to the ABS, the Australian Bureau of Statistics survey, around 57% of all businesses have reported rising costs over the last 3 months. As a result, we have noticed a steep rise in the number of corporate insolvencies to around 466 in more recent months. Meanwhile, the sectors that have been most vulnerable include hospitality, building construction, and retail.
Yeah, it's a highly sensitive environment. These are certainly worrying figures, Kien, from an insolvency perspective. In the first half of the year, the market became very complacent and highly speculative stocks and assets, including Bitcoin, rallied on the back of low interest rates and government and central bank support. However, the speculative nature of the market is now unwinding, and many financial unhealthy stocks, such as those in the buy now, pay later space, down significantly for the year to date. So yeah, we were saying it for a long time, weren't we, Kien, that the highly speculative environment was simply not sustainable.
Yeah, everything's unwinding, Tim. And meanwhile, within our database, we've recorded 8 failures over the 2022 financial year, and we expect this number to rise in the year ahead. No industry is really immune, Tim, as these failures have come from various sectors, including healthcare, the financials, manufacturing, and mining as well.
Yeah, so looking at what we need to do in this environment going forward, Kien, I mean, the volatility is going to remain, insolvencies will probably increase. So there's no time to be complacent with the management of our portfolios. We understand that rising interest rates and inflationary cost pressures is weighing on economic growth, and this could eventually translate into weaker corporate profits. In fact, there is a risk that the economy could move into a recession or even experience stagflation, which means having low economic growth and high inflation. But we believe a reset is healthy for the market. It removes the speculation and many zombie companies that should have collapsed a year ago. As Warren Buffett once stated, Kien, only when the tide goes out do you discover those that are swimming naked.
Yeah, that's right. And that's why we have our financial health team to help us ride through that. But the reality is we don't know what will happen in a year's time. So we really need to separate the facts from the noise and ignore the market expert forecast, Tim. Our economy remains quite strong, with corporate earnings still resilient and unemployment at historical low levels as well. Rich in natural resources, Australia is a major exporter of commodities, and our economy benefits from elevated commodity prices during inflationary periods. This is the reason why corporate earnings have held up over the last few months, and you can see this with the chart on screen, which compares the All Ords Index in blue to the trend in the 12-month forward earnings in black. But we need to keep an eye on the active risks, Tim, especially with reporting season on our doorstep pretty soon. Now, just this week, both Star Growth Stock, Oz Minerals, and Borderline Star Growth Stock, and gold stock as well, Northern Star Resources, they released production downgrades on the back of ongoing COVID disruptions, like staff absentees and high energy prices. But at the end of the day, these issues should be transitory, and the long-term earnings drivers for these stocks will depend on where commodities prices go.
Yeah, and even though earnings could drift lower, Kien, in the next few months, the reality is there remains a significant divergence between share prices and the corporate earnings environment. From a valuation standpoint, the market PE is now one standard deviation below its historical average. Often through history, these periods present exceptional opportunities for investors. The market is a lot cheaper than what it was a few months ago. With the current market cycle, it is important to reevaluate your portfolio, have risk management strategies in place to ride through this cycle of uncertainty. Keep in mind that with share investing, equities could fall 50% every 10 years. Be diversified according to your stage of life, net worth, and sensitivity to share price volatility. Growth-oriented investors should ideally concentrate their portfolios on financially healthy businesses with strong growth metrics. Income investors should align with companies that have sustainable dividend yields to ensure you continue to receive a steady income stream, irrespective of the underlying stock volatility. In the words of the great Peter Lynch, the author of One Up on Wall Street, you get recessions, you have stock market declines. If you don't understand that's going to happen, then you're not ready. You won't do well in the markets.
Yeah, that's right, Tim. And to reiterate as well, Tim, you've got to take advantage of those oversold quality opportunities that should eventually rebound once inflation gets under control. And with the reporting season around the corner, sometimes it may be best to confirm the fundamentals before you jump in. And take, for example, with borderline star growth stock and restaurant operator Collins Foods. Now, consensus analysts were downbeat on the stock leading into its results this week, with earnings and target prices being revised downwards on the back of rising input costs. However, the company was able to report better than expected profits, with earnings rising by about 25%, Tim. And being a quality business, management was able to defy the odds by opening new restaurants and also implementing price increases as well. And to look for these opportunities, you can use Stock Doctor, which can help investors. For example, you can generate a list of ideas by running a filter containing our star stocks, have 6-month price change there to look for the opportunity or oversold opportunities, and also positive earnings revisions over the last 3 months to see whether these companies, their earnings are still holding up.
Well, we've certainly been busy in the office too, haven't we? Been, Kien, with our working closely with our development team on a number of enhancements that we've rolled out over the last 12 months. So even during these unprecedented times, we've been really hard at it to ensure that we're giving our members all of the tools that they need on top of what they already get within Stock Doctor to manage their portfolios with confidence, control, and peace of mind. For example, we recently introduced Lincoln Live as a value-added service, which is a member-exclusive live Q&A session that we run every Monday morning. So for those that haven't attended Lincoln Live, we encourage you to do so because the feedback has been great. And in Lincoln Live, we cover off on what happened in the previous week, what's going to happen in the coming week, and stock discussions and also strategic discussions.
Yeah, and much earlier in the financial year as well, Tim, we can't forget we did present improvements to our star growth and borderline star growth stock selection process following years of backtesting. We also added our new criterion to Golden Rule 3, the EPS forecast 12-month revisions, and you can see that on the Stock Doctor screen as well. We also launched key financial metrics under Golden Rule 4 chart and the advanced charting tool as well, so members can visualize the trend in the financial ratios such as return on equity, the net profit margins, even forecast earnings revisions and PE ratios as well, Tim.
Yeah, and I think too, you and your team, Kien, the team of analysts have also really made our analyst comments, and we're constantly working towards this to really comment on the golden rules and anything you observe within the golden rule screen and complementary or supporting screens relative to the golden rules. So they're commenting on anything that they see that they need to bring to our members' attention in the strategic comment or also in the active risk. So really constant improvement there as well. We've also incorporated Stock Doctor's technical indicators, SD Max and SD30 TSR, into the portfolio managers' investment profiles to assist trend-sensitive investors when they're setting up their portfolio. So it only recommends stocks that are not in breach of either of those two technical indicators. We've also added consensus price target options under the alert. So you can now be alerted when consensus analysts out there are adjusting their price targets or earnings revisions. But last but not least, we've also added a dark theme. And Dave, our production manager looking after today's recording, is our web developer, and he's a big part of the dark theme that's now available in Stock Doctor to allow members to see a Stock Doctor with a darker background, similar to how you view a Bloomberg screen or something, or the option to view with a traditional white background. And members can now also lock screens when they're viewing 9 golden rules screens. So when they call up a new company, it will automatically go to the screen they were last at with the company they were looking at previously. But our thirst for innovation does not end there, Kien. Over the next year, we'll continue to roll out enhancements to the Stock Doctor platform, such as a new portfolio import feature, which will allow members to import bulk historical buy and sells transactions from a number of the more popular and used online brokers out there. But well, that's the year's wrap, Kien. Wonderful working with you and your team and all the team at Lincoln to deliver on what we're most passionate about. And that is equity research and tools through Stock Doctor to our members.
Yeah, that's right. And we're always here to hold your hand for our members and investors as well, especially during this volatile period, Tim.
Yeah. So thanks again, Kien. But the key messages I want to leave our members with is in the new financial year that began today, don't panic. It's no room for panic. Don't let fear and emotions dictate your investment decisions. Stay disciplined to your investment strategy and have strong risk management processes in place by investing in financially healthy businesses that can withstand the challenging economic environment that will last for a while. And lastly, use the upcoming reporting season to take advantage of oversold opportunities once the fundamentals of those companies are confirmed. History has proven time and time again that volatility does create wonderful investing opportunities. Stay the course, and this current period will be a small blip in the future of long-term trend for the share market and, of course, our star stocks. Take care and have a happy, healthy, and prosperous year ahead.